In 2022, many things have changed for investors. In a small mini-series, I want to explore with different tech-focused investors how they're maneuvering this challenging environment. Today I'm having Baki Irmak of the Digital Leaders Fund with me. But before we start the video, I want to present you a small message from our sponsor. This episode of Good Investing Talks is supported by Interactive Brokers. If you're ever looking for a broker, Interactive Brokers is the place to go. I personally use their service because I think they have a great selection of stocks and markets you can access. They have super fair prices and a great tracking system to track your performance. If you want to try out the offer of Interactive Brokers and support my channel, please click on the link below. There you will be directed to Interactive Brokers and can get an idea what they offer for you. I really like their tool and it's a high recommendation by me. And now enjoy the video. Hello Baki, it's great to have you here for our interview. I already had you on the channel in German, but we haven't talked in English, so it's maybe helpful to introduce you for the beginning.
Okay.
And let's go a bit back. Baki, what did you do before starting the Digital Leaders Fund?
Well, I started my career actually in the 90s. It was exactly the time of the Dotcom crash. I started actually a couple of years earlier. So I saw all the benefits and all the an interesting time around, the start of the internet and the IPOs of the TMT stocks and so on. And I then moved on to another company, to Commerzbank, was managing mutual funds there, and later I joined Deutsche Bank, did a couple of different jobs there, but in 2014 I was running the digital business of Deutsche Asset and Wealth Management, the today's DWS, and in 2017 I left Deutsche and founded actually our investment boutique, Pi4 Capital. And the idea was actually, given all the experiences I made in the digital business, the idea was actually to start a fund focusing on company thriving in the digital age. Yeah, and what we analyzed back then was that there are a lot of tools besides, the fundamental valuation approach. There are a lot of tools like looking at the digital exhaust, the digital footprint, and investigating the digital KPIs in order to evaluate whether a company is successful in the digital age or not. So we launched our first fund, the Digital Leaders Fund, back in 2018. And in 2021, we launched another fund with the same approach, focusing on companies thriving in the digital age, but in emerging markets. And since February 2022, we also have a China fund called China Digital Leaders.
This is a very interesting journey. Let me raise a follow-up question here. You said you lived through the .com crash. So this crisis, what does you remind of the .com crash and what is different now?
Well, I mean, of course, valuation, is a topic you have in your mind when you think about the fancy valuations we had in 2020, 2021. And when you compare that with the valuation, with the inflated valuations you had actually in 2000 or 1999, 1998. And it was interesting. I mean, when you look at back then, you had a couple of companies, probably out of, I don't know, the 500 companies in Standard & Poor's, you probably had some, companies like 50 or 100, with valuations which were something around, enterprise value sales around 10. And, back then when we had this discussion, I remember, I mean, that was very inflated. People, were really surprised, how in evaluation of enterprise value of a multiple of, well, enterprise value of 10 and above is actually possible. Yeah. So I still remember some of the discussions we had back then. But when you looked at 2020, we had, I mean, we had, I don't know, I mean, hundreds of companies actually having a valuation far above this multiple of enterprise value revenue sales above 10 or 20, or even in the, some e-commerce companies that valuations far above EV sales, above 50, and the cybersecurity companies. And still, interestingly, still after even such a severe sell-off, you still have companies around with a very, very high valuation. So that's the one parallel I have in mind. The other is actually, I mean, it's not a sudden sell-off, a sudden crash we have currently. It's a kind of a salami crash, how many people call it. So it's a more painful experience for fund managers, for everyone who is investing. So it doesn't happen, within a day. So, the rotation from value to growth happened probably, somewhere summer, autumn 2021. And still the valuation, the volatility levels, the implied volatility levels, I mean, the VIX is around 31. It's not at the levels of somewhere around 50 or somewhere around 80, what we had actually in the pandemic crash. But there are also a lot of differences, actually. I mean, and one of the differences is back then there was no smartphone, first of all, so there was no iPhone, there was no smartphone. Access to information was probably different. Um, and so that's one thing. The other thing is, I think you can't compare the Nasdaq back then to the Nasdaq today. The premiums you had actually after a crash or during the high levels of 99, 2000, the premium of, let's say, Standard & Poor's IT against the average Standard & Poor's, the premium was above 100. Looking at PE levels. Today, I mean, the premium level is actually much, much lower. It's something like 20, 25%. That's actually the average premium Standard & Poor's IT companies had actually in the last 25 years against the average valuation of Standard & Poor's. So valuation levels came down, I think, dramatically. I mean, already. And the other experiences, when you look at, the .com crash. So the legacy companies, they were actually the established companies, and they didn't have to catch up. They did their business, and they didn't fight for survival. It was actually more the new companies, the startups, and the newer companies were actually trying to survive and trying to catch up, trying to make some money. Today, I would say it's a little bit different. Actually, I mean, we have a completely different environment, and I would say the legacy companies still, even when you look at the market, it's probably different, but these legacy companies are probably trying to catch up when it comes to adoption to the digital age. And I think there is no question behind a lot of the companies we are looking today experiencing a huge sell-off, that they actually will survive. I think there is no question behind companies even in the cybersecurity area fields, that there is no question whether they survive or not. It's just a question, what's the right valuation actually?
Let me raise another follow-up questions. You already mentioned digital tools. So what are your 2 to 3 favorite digital tools in the stock analysis? We already did a video in German, which I will link up here for the ones who are interested in this as well. But what are your favorite 2 to 3 digital tools?
So the approach of our team is actually how to measure actually digital intangibles or intangibles. I mean, as you know, um, the valuation of most of the companies actually in the Standard and Poor's is actually determined more through uh, intangibles than tangible assets. Yeah, and the question is how to measure the value of the intangibles. And I think one approach is, to look at the digital footprint. So to give you just an example, we look, for example, of we look at app data, so app analytics. So we look at downloads, we look at monthly active user engagement numbers, and if you look at monthly active user and daily active user, and you take, you divide daily active user through monthly active user, you get actually good sense for stickiness. So how sticky are the clients? How loyal are the clients to the business? How engaged are the clients? And so app analytics is, I think, it's a very good approach to understand the company's traction. Also, it's a, helps you a little bit to nowcast actually the company's success and not to wait for uh, the quarterly numbers. Another uh, approach is actually looking at traffic numbers. Yeah, looking at traffic numbers. So you look at, how traffic evolves over time, and of course you have to differentiate between paid traffic and organic traffic on the one side, and then you can, deep dive into these numbers. You can have probably more granular data if you look at, not only top level domain but also at churn data. For example, if you look at Netflix, or if you look at um, Peloton, for example, I mean, the traffic data or the app usage data actually gave you a very good sense that something is wrong with growth of this company. So these are, two examples. We look also, at numbers like ad spend, and try to understand how people spend uh, uh, digital advertisement money. What are the platforms that they favor? And then, but we also look at numbers like in LinkedIn, employee numbers over time. We look at Glassdoor ratings and numbers over time. So these are a couple of ideas, how the digital footprint gives you actually a good sense to analyze companies.
So let me bring this back to your funds. So what is the digital leader strategy you're following with your funds?
Well, as I said, I mean, we're investing in companies. We believe they thrive in the digital age, and we think that they, are part or even dominate a secular trend within the digital age. But we are not just focused on tech companies. So we think that there are three kind of winners in the digital age. So there are, on the one side, the legacy companies. Legacy companies uh, uh, who are able to adapt to the digital age, and they use technology in order to become better companies, to improve their business model, and usually they are leaders in digital adaptation in their peer group. So the companies like BBVA within the bank sector. And then the second category we call um, digital business leaders. So typically these are platform companies people are familiar with. So Meta or Alphabet. And so usually they do 100% of their revenues through digital channels. And the third pillar is, we call these companies digital enablers. So companies who enable digitalization with software, hardware, or services. And typically, these kind of companies are actually, we call them also the architects of the digital world. And typically, these are high growth companies. And often these are companies, they pick, a small niche within a sector, and they dominate it. And they are, they use digitalization technologies like, yeah, agile deployment. They measure the feedback of the client's immediate response and make the product just better by doing that. And so when you look at the legacy companies, they probably, I mean, today I would say some of them are even, probably um, a more or less value companies. The digital business leaders are, you know, are growth companies, but fairly attractive, valued, and then with the digital enablers, you have actually more or less, yeah, high growth companies. So together, it's actually a unique risk return profile. So together, you get a kind of a convex portfolio, and try to navigate with this kind of risk profile actually difficult markets.
So this raises some portfolio constructions questions for me. So these three pillars, how have they reacted with each other in like the last period where a lot of the digital businesses profited from low interest rates and went up a lot? So how have these three pillars acted together in concert?
Yeah, obviously. I mean, we had tremendous uh, performance actually in 2018 even. I mean, when the market was actually negative, the portfolio was um, did a performance of something like 2.5% in 2018. 2019 was an amazing year. 2020, we had the pandemic, and interestingly, so typically when something like a crash happens, people invest in value stocks. The pandemic was a different experience. February, March 2020, people actually sold value stocks because, I mean, all companies somehow dependent on supply chains or doing something physically, doing something tangible, had the issues, and all the software companies did actually great. And then we had this huge boost of digital economies, and so the digital enablers did amazing. And back then, even in the summer, I mean, we had also our conversations. We discussed uh, the valuation levels even back then. So even back then, it didn't feel right, because I mean, 5 years, 10 years growth was actually already uh, priced in the stocks. And so in 2000, so we started actually in 2020 already to switch a little bit from digital enablers towards digital business leaders, and some of the legacy companies. So 2021, um, we did actually fine, even after the market started to rotate actually from growth to value. So the performance was around 20%. At the end of the year, it was, I think, 80% in 2021. And then it looked actually for us, so it looked like in February 2022, the world was like, well, GDP growth will be okay. The market will come out of the pandemic just fine. Um, the interventions of the governments and the central banks helped a lot, of course, to rescue the economy and the business model of a lot of companies. And it looked like, so we are probably coming back to a trajectory where um, some of the growth companies could flourish again, even the valuation. And when you look back, we had inflation expectation uh, had a high. I mean, 2 years, 5 years, 3 years inflation expectation was up actually in autumn 2021, but in February it was completely down. The inflation expectation was actually really low. So everyone's sense was, or most of the people's sense was, this is really something uh, transitory. And then Russia happened. I mean, with the attack of Ukraine through Russia, the world changed, in my view, completely again. And I mean, when you look at before 2022 and after 2022, I think so. A lot of things look now very different. Like interest rates are dead, interest rates are back, and it's not about blitzscaling and land grabbing. It's all about investors want to know, hey, show me the money. It's not about the target addressable market. It's more about a return on investment and weighted average of cost of capital. So, and in this environment, the portfolio got a big hit. So we are somewhere around minus 32%. So um, so if you compare us with funds like ARC or some of the other funds focusing on actual digitalization, on digital models and new models, so we are far better. But it's actually not a performance I'm happy of course. But nevertheless, the risk return profile of these three pillars helped actually to limit some of the losses compared to some funds in the peer group.
So the interesting question in investing is always like, what are the future returns? And in your eyes, what has changed here with this kind of new macro setup with inflation? And what do you see here as opportunities?
Yeah, I mean, I'm not trying to guess whether we get a recession or not, or how severe the recession is or not. I look at the numbers, and when I look at 5 years inflation expectations, which are priced in the inflation protected bonds. Now, so market doesn't expect actually, that inflation will stay up. I mean, obviously, inflation is really high, and probably the next month and quarters it will stay high. But if you look at market expectation about inflation, it's around 2.4, 2.5%, 5 years inflation expectations. So that tells you, that the market has a very clear view. Inflation will be not a long-term topic, So the question is, so whether you want to compare this time with, with 73 until 83, or you want to compare this time probably more with the dot-com bubble. Yeah. On the other side, um, you know, when we look at valuation of different kind of stocks, and especially, for example, we are also invested in finance. Some of the banks, digitally probably mature banks, and some of the fintechs. That tells you also a different story. If you look at, for example, European banks, I mean, they got a severe hit. I mean, at the beginning of the year, as I said, the world was absolutely fine. Uh, so the European banks, after a couple of years, actually probably decades, they had a good year in 2021. 2022 started actually excellent. When you look at the numbers of the banks, they look good. The non-performing loans are very low, below actually the 20 years averages. But when you look at the stock prices, you know, they imply something completely different. They imply actually not a recession. Uh, they imply more a depression, actually, or a severe recession. I looked at a presentation of Credit Suisse the other day, and so they said actually the valuation of the European banks, they imply um, currently drop down of house prices of 40% in the next 3 years. They imply an unemployment rate in Europe of around 12% in the coming 3 years. And they imply uh, a contraction of the GDP of around 10 to 12%. So looking at, the valuation of banks, so the picture is pretty different. So the question is for, as a fund manager, you have to look at your numbers and then, or at these numbers and have to analyze what the market actually tells you. And then you have to make your own positions and your own bets. So I'm not actually in this extreme pessimistic camp currently. So I think there are a lot of questions we can't answer currently. I mean, which are macroeconomic topics like zero COVID in China, uh, of course the war of Russia against the free world and against Ukraine, and all the effects and consequences that brings with it. So it's really difficult to answer the question. So what we do actually in this kind of environment, we try to stick to a stock picking approach and valuation actually. So example is let's say you compare the this current environment actually with something the dot-com bubble. So, and the experience back then was, well, we had a sell-off from 2000 to 2003 in the Nasdaq of 70%, 77%, and but the sell-off, individually for the stocks was not from 2000 to 2003. So for Amazon had the law in October 2001, and actually from October 2001 till October 2003. Amazon performed actually something like 800%. So from the law within the crash, in the middle of the crash, actually 1.5 year later, you had actually a performance of 800%. Yeah, there is no time period where you had this performance. And even, I mean, most of the people, when they look at Amazon, they look at probably, or they would suggest that Amazon did this huge performance from 2011, 12, till today. So when AWS, convinced the markets and Amazon came with Prime and, margin went up and so on. But actually from 2011, 2012 till today, Amazon performed, I mean, pretty good, but, something like 750%. What I want to say is, you can't, so sometimes it, for Amazon, it was definitely, for investors in Amazon, was definitely the best time to buy Amazon was actually in the middle of the crash. So the other thing is, when you look, so the valuation of Amazon back then in the law in 2001, when they really hit the law, was something like 5 times gross profit. 5 times gross profit. And when you look at, some of the companies, I mean, I saw you interview Tarek Müller from About You, and then there is another e-commerce play in Germany, Zalando. I mean, Zalando, for example, is a solid European e-commerce platform. They're profitable. I don't think that Amazon will go bust. Zalando. But Zalando is currently valued with 1.5 gross profit. So compared to the 5 times gross profit, actually Amazon when it hit the low. So this gives me a little bit more comfort, than looking at macro data. So, and when we look at, our portfolio, so that there are a lot of companies, where I'm perfectly happy with the valuations level currently. And I think that's the best uh, approach you actually can have in these kind of markets. Look at valuation, look at the business models, stick to your portfolio. I mean, what we do, of course, we have a growth bias. So there are some of the companies which are, very attractively uh, valued, where you have already discounted probably to the value today. But then there are companies, where we believe that they do something different. They will, be probably the next big, companies in their field, and there we accept, higher prices, higher valuation. And I think it's very important that you have a good diversification of this, you know, uh, kind of companies in your portfolio.
So let us jump here a bit more on a meta level, and talk a bit about, on the one side, digitalization and inflation on the other side. So what do you think about both terms and how they play together? And is there also maybe a deflationary nature of digitalization? Like, for instance, in one podcast I heard to prepare for this interview, you mentioned that there's Nubank. They are able to acquire customers for like $2. It's a Brazilian bank, and if you think about like a typical branch bank, it's super hard to imagine that they will acquire customers for the same amount of money in their branches. So what do you think about like these two ideas in play?
Yeah, I mean, there is one big paradoxon actually in the market, where where you would actually assume that all this digitalization actually would lead to a huge productivity gain, and so that the companies are much better off, um, and that would lead actually to a decrease of inflation. So productivity gains. I mean, typically we had actually huge productivity gains actually in the 90s. But when you look at the economy overall, you don't see that much. And I think the one reason is that legacy companies struggle a lot with implementation of digital tools or technology. And typically, typically when you worked in a legacy company, you buy a software tool, you pay probably 10% for the software and 90% for the implementation, and then the whole digital transformation journey, to convince all the employees. Culturally, it's a big, it's a tough exercise. Digitalize a company in the core is really tough. And so you lose a lot of your productivity while doing that. So that's the one thing. So, and when you look at data individually, then you realize quickly that from company to company, the productivity levels are very, very different. So, I mean, Apple, Microsoft, Alphabet, and Meta's productivity levels are probably much, much better, and they had huge productivity gains actually. And with companies who are much more advanced in their digital journey, like companies like BBVA, for example, they started the digital journey much earlier than probably other banks. They did it probably with much more management commitment than other banks. Typically, the CEO, is part of the the agile product developments and teams, and he's not someone who is letting others do the work. And so when you look at BBVA, I mean, the cost income ratio is around. I mean, the last quarter, the cost income ratio was 40.7. 40.7. So this is absolutely unique within European peers. When you look at, in first quarter, they were able to acquire something like, 2.34 million clients through digital channels, not through branches. And yeah, and of course, fintechs like Nubank. I mean, Nubank is actually a great example of how successful a bank, neobank could be. I mean, yeah, as you mentioned, I mean they had something like 5.5 million clients in Q1, new clients. I mean that's extraordinary. in Brazil and Colombia and in Mexico, and yeah, the client acquisition cost is something around $5. I mean, that's huge. That's very, very efficient.
Here, I want to come back to the digital transformation leaders. As you already explained, there's a certain trickiness in the digital transformation. So how do you make sure that you invest in a digital transformation leader that is not a turnaround that doesn't turn, and like where you have efficient digital transformation?
Yeah, sure. I mean, so ideally, you can measure it. Ideally, the digital footprint tells you a very clear story. So in retail banking, it's quite easy. You look at the apps, you look at the traffic numbers, you look at the number of um, uh, products they sell through digital channels, and then you look at how the numbers improve, cost income ratios, whether they go down, um, how a client acquisition actually works, and that tells you actually then pretty straightforward story. So it's much tougher to measure with this kind of approach, your success in investment banking or in M&A and in other area. Um, so that's one approach. But on the other side, so when we analyze banks, of course, we look at all the fundamental numbers, of course, too. I mean, obviously, net interest margin development. I mean, typically banks should actually profit now from the current environment, and they do on that side. But the skepticism around loan loss provision, um, and uh, and probably some of the accounting standards are probably misleading currently a couple of investors. Like, I mean, with IFRS 9, you have to account credit losses, or you have to provision actually uh, um, expected losses, uh, and and that leads to a strange picture currently. Like, if you have companies who are really doing good in their loan business, they are growing dramatically. So typically, they don't uh, they don't have the revenues of these loans in their balance sheet currently, or in the numbers, in the quarterly numbers, but they have the provisions actually, so the expected loss provisions. Yeah. So like with Nubank, you have this picture. EBITDA is 10 million, but expected credit losses are something like 880 million. Um, so it depends on how the trajectory of the macro environment is, and how the loan losses will be really effectively. That will change dramatically, the profitability profile of a company. It's less an issue with established banks, but for example, for banks like Nubank or banks like Lending Club, it's a big topic.
So in the digital leaders family, you have three funds. One where you're in the focus with, I think, mostly North America and Europe. And then there's the China fund and the emerging markets fund. So what do you see from the other regions? How is inflation influencing valuations and companies there? What is different in the regions in the emerging markets and in China?
Yeah, I mean, if you look at emerging markets, I mean, in the old days, emerging markets, where uh, you invested actually in banks and commodities. So these two sectors dominated actually emerging markets, and it's still more or less the case. There are also some other established companies and probably some newer companies, but commodities and banks dominate emerging markets. So obviously, in commodity-rich emerging markets, should actually profit from this development. And on the other side, at the beginning of this kind of a inflationary environment, they get usually a big hit. So, and some of them reacted, yeah, quite, nimble or harsh, actually, the way how they approached actually the whole inflationary environment. Like, for example, if you look at Brazil, the interest rates, the Selic, actually, so the leading interest rates from central banks went up from something like 2 to 13.25%. So, forget what you see in the US or in developed markets. And the US already started this process. Europe is still rhetorically, preparing for this, the first approach. Nevertheless, the interest rates reacted already. But so you had huge headwinds, macro headwinds, actually, in a lot of these emerging markets companies. So and this is not just Brazil. Brazil is probably an extreme example, but most of the emerging market companies increased, interest rates. And whether it's Colombia or it's Mexico or it's or Thailand or Indonesia or all this, and so that in some cases it helped their currency, but it didn't help actually GDP growth. Nevertheless, um, um, you know, so typically, in this kind of environment, emerging markets should actually benefit. But then you had, external, or you had, in China and in Russia, you had something you haven't experienced actually before. Two countries who could have been the big winners actually of an environment like this. Look back at the dot-com bubble from 2000 to 2003, when the market collapsed actually in Europe and the US. China did something like 125% performance, positive, increase in 2000 to 2020, 2003. And Russia was actually also a very good market. I think something like 100% back then. And Russia could have been, the big winner actually currently also. But, in both cases, their presidents, damaged the destiny of their country dramatically. And and that helped some of the emerging market countries, and and some of them suffered. So when you look at what happened in China with the regulation, with zero COVID, and with trying to come up with a narrative like the NATO is the reason why we have all these issues. That led actually to interesting development actually in the neighbor countries of China. Thailand, Vietnam, Indonesia, and Malaysia benefited a lot. So a lot of money was actually allocated from China to India, to Vietnam, to Thailand. So they did actually quite good, especially in 2021. And but overall, I would say we are quite, constructive for commodity-rich emerging markets, and we think they have a lot of amazing companies, digitally very advanced. Some of them, leading in the continent, and prices are, came down a lot, and so these stocks suffered, but valuation levels are low. And we think some of these companies offer good investment opportunities.
So then let's break our interview to the company level. Which companies do you especially like at the moment?
Yeah, as I mentioned, so we spoke about BBVA. It's actually a Spanish bank, but being having a headquarter in Spain, but most of the business is actually from emerging markets in Mexico, in Latin America, and in Turkey is a very important market for them. So that's a company we like in the digital, in the legacy company area. We spoke about Nubank. I think it's I don't think that there is any neobank outside China probably and India, growing with this pace, and that successfully, actually profitably. And um, the valuations level were very high when they did their IPO. Market capitalization was something like 40 billion. Came down now dramatically. Enterprise value is around now 15 billion. So much more investable currently. I mean, is Nubank? Why shouldn't be Nubank actually priced higher than an established bank in Brazil? Um, I think they're doing good. They are not actually that dependent on capital markets. They did an IPO. They raised a lot of money. They have 3 billion cash. So they could even benefit from some opportunities for mergers and acquisitions actually in their segment. So that's a company we like. Um, Another company in the emerging markets we like is Kaspi. Um, it's actually, I mean, a leading fintech company in Kazakhstan. But the unique thing of Kaspi is actually Kaspi is probably something like a Mastercard, PayPal, and Amazon in one, of Kazakhstan. They have a huge market share, and they're that successful in acquiring on the one side, and with merchants on the one side, and then with clients on the other side. So they don't need actually the infrastructure of of the rail of Visa or Mastercard. So I think that's quite unique. So the PE is around 7. The market of this company, it's very profitable. Um, the numbers were great. But of course, I mean, being so close to Russia, uh, there are not a lot of investors currently investing in Kazakhstan. I mean, the approach of President Tugayev is actually quite, balanced, constructive. I mean, he made very, very clear that he will not accept the new states in Ukraine, proclaimed by Putin and by these people there. So he tried to balance, out, all the interest between, Russia on the one side, China and the Western world on the other side. I think, doing quite job, but of course, obviously, you have a lot of country risk and macro risk in Kazakhstan. Another company, we have in the portfolio is one of the top 10 in the portfolio is Spotify. I mean, you're familiar with this stock, so we believe is it's it's actually a quite interesting platform. It's Europe's most successful platform and has 422 million clients, 180 million paying clients. Unfortunately, I mean, everyone knows they have a margin issue. So most of the money they have to pay actually for the labels, and the labels are dominating the music industry. So, but nevertheless, they were able actually to increase the gross margin, from something like 25% in 2018 to now something like 28%. Comparing that with the gross margin of Netflix of 45, so you see that there is a huge gap. But they realized, they will never be able to negotiate better rates actually with the labels, and most of the music, and especially the vintage music, which is actually mostly streamed on Spotify, is gone. They can't buy or exclusive rights or whatever. But what they did, they did the same actually with podcasts. I mean, they realized producing music and producing podcasts is probably a very similar business. And the creators in the podcast industry, they don't have any exclusivity contracts with the labels. So they started actually then the same business actually the labels did with musicians. They started actually with
Now Spotify is the biggest labels in the world with all the podcasts they have.
exactly. And I think what so currently the contribution to the gross margin is negative because it's at the beginning, but it's very clear. I mean, when you look at the revenue numbers, it's 200 million from podcast, almost 400 million the last quarter from advertisements, and they just scratch the surface. I mean, they started in the US. They haven't started their advertisement business actually in Germany and Japan and UK and and the big other markets. They just started it, so I'm quite positive there. And I think also you know, uh, they're starting now to offer audiobooks. Also interesting business. I mean, they were able to uh, prove that mass adaptation from of their clients works for a different offering. I mean, within 3 years, they're now market leaders actually in podcast. An audiobook, I think, is, I mean, the next logical steps in my view. So when you look at valuation, is 1.5 of um, revenue multiple compared to 3 of Netflix. But ARPU in Netflix is much much higher. Gross profit is much much higher. But Spotify is cash flow positive since 2016. Not dependent that much on market. They can finance organically their growth. And I personally think that they are undervalued. Yeah, and probably that's my European bias when I invest. But that's a company I pretty much like actually to have in my portfolio.
Let me invert my question a bit. Are there any companies you liked like in 2019, 2020 you currently don't like anymore?
Yeah, sure. I mean, we had a couple of companies. I mean, you are aware of some of them. I mean, we had the Trade Desk, amazing company, still amazing company. Just valuation is just too high. We were investors in HubSpot. Similar comments like uh, regarding the Trade Desk. It's a great company. It's growing still, but valuation is still too high. I think enterprise value sales above 10. It doesn't work in this environment. Yeah. DocuSign is another company we had. We sold, and but all these 3 companies I'm willing to buy when the valuation is fine again. And then there are other companies, like Peloton. Like we had them. We invested actually very early in Peloton. Around 18, $19. Went up, I think, till 140. On the way up, we sold a couple of stocks. On the way down, we sold also. And then at 40, 40 something, I made a clear cut. The main reason was actually, I mean, first of all, the management was not honest. You remember the conference call where the JP Morgan analyst asked the CFO whether their cash burn is probably not too high and they need probably money. They said, no, it's absolutely fine. We don't need more money. There is no corporate event, coming up soon. 2 weeks later, they did they sold shares, did a capital increase. They needed, cash immediately. The cash burn was far too high. Of course, I mean, the management changed. Still, the need for cash flow is huge. They, uh, did a couple of things wrong. I mean, there's a lot of sunk costs. And looking at the digital exhaust, digital footprint, we don't see that the situation is getting better. It's actually getting worse. And that's not the same with the DocuSign or with Trade Desk or with HubSpot. It's just the valuation topic there. So I think that gives you a pretty good idea how we approach actually these companies.
So how are you thinking about debt in the companies you're investing in? I personally try to stay away from debt and just have like a tiny amount of debt or no debt at all. You could also make the argument with inflation, like if you have a high debt load, it gets easier and easier to repay it. So what do you think about debt?
Yeah, I mean, so there is a main difference between government on the one side dealing with debt and with companies dealing with debt, especially with, real interest rates. So when you look at real interest rates are negative today, still negative. I mean, we have inflation levels of 7, 8%, but the interest rates are, much lower. So that's great for, governments, of course. It's great for governments, financial repression, by doing nothing, actually, they get rid of the debt. It doesn't work for companies. So companies, so the financial repression doesn't work for companies. So debt, in such an environment, will hurt you. And especially if you are a growth company and you can't finance the growth with your operating cash flow. So when you are not able actually to finance your growth and you are dependent on capital markets, that's not something we like in the current environment. And typically in this in this environment, people talk typically that dividend yields are a great indicator, for good performance in this environment. But at the end of the day, I mean, dividends are kind of a derivative of cash flow. So we look at actually high free cash flow margin, so that's something actually we it's very important in this environment. So a low valuation with a high cash flow margin, I think that's something people look at and try to avoid actually, highly debt companies in this environment.
So have you, compared to 2020, 2021, have you generally changed something in your checklist? Like compared to the time where we had the split scaling setup?
Yeah, I mean, as you know, one of the KPIs we like, is the efficiency ratio. So you look at the, top line growth and the free cash flow margin. And so in this kind of environment, the focus is more on actually the free cash flow margin than the top line growth, actually. So, um, so 2022 is actually probably the year where people uh, discovered the simple valuation metrics like PE ratios, price to book, and this kind of stuff. Uh, and so that is actually something changed, obviously. So looking at the efficiency ratio, the focus is more on free cash flow margin than top line growth, and profitability is now what people care about, and that's important. But for us, it's I think very important to distinguish between um, hits to the Geschäft, to the sorry Geschäfts
Business model.
yeah, exactly. So hits to the business model, which I explained actually by temporary external effects, or and between sequential or secular changes actually. Yeah, and so I think this is absolutely key. So I don't think that e-commerce is dead. But of course, I mean, we just had a event which is unique in a probably in a century, even like the pandemic we experienced, and that led actually to a huge change, behavioral change, actually, the way how we consume, and the way how we probably interact and so on. And so I personally think that, after this huge sell-off in e-commerce, for example, there are great opportunities there. Um, so there are a couple of trends where we still think these are secular trends, and they will determine stock valuation going forward. Short term, you know, um, everything is more dictated actually by sentiment. But long term, you have to look at the business model, and you have to look at the valuation levels.
So, for the end of our interview, I want to give you the chance to add something. Is there anything you want to add people should know about the Digital Leaders Fund or like the current setup that's noticeable?
No, I think that was a quite comprehensive um, discussion actually on markets. Probably there are a couple of topics we probably a lot of topics we actually didn't discuss. But whenever someone has a question, so um, we have a pretty transparent website, and so most of the companies we invest in, we we write actually articles on them and update articles also why we invest and sometimes why we don't invest, like Wirecard is a good example. And so people, please, to everyone, feel free to reach out whenever you have a question.
This is a really good closing statement. So thank you very much for coming for this interview, and thank you very much to the audience to listening to now. And now it's time to say bye. Bye-bye.
Bye.
As in every video, also here is the disclaimer. You can find the link to the disclaimer below in the show notes. The disclaimer says, always do your own work. What we're doing here is no recommendation and no advice. So please always do your own work. Thank you very much.